This is my financial disclaimer so I don't get sued. Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. I'm going to be going over the data sets, talking why I believe a recession is coming pretty imminent, and I will be doing the technical analysis for the SPY and TLT for December 18th, 2025. And with that said, let's go ahead and jump straight into the data. Now, on Wednesday, December 17th, the 30-year auction did not come in very good. It had a tail of 5.2 basis points, which is not really what you want to see on the 20-year auction, but it's not the worst because we saw both the 10-year and the 30-year auction come in with a very little to zero tail, and the interest in both of those auctions were pretty decent. Um, The auction results today weren't good at all. They weren't exactly terrible, but the interest in the auction was not exactly there. No, that doesn't really change the TLT thesis or anything right now. That's kind of part of the cycle we're in, but that definitely doesn't exactly help the price action in the short term. Now, for Thursday, December 18th, we do have the CPI in the pre-market, as well as the initial and continuing jobless claims. Now, this CPI report is pretty important because it has, um, we haven't been able to get an accurate reading of the CPI and everything during the government shutdown, and now we're starting to have a normalization of all the data sets. So being able to see the CPI will be very nice, and they're expecting a slight uptick. Just read this over. So the year over year, they're expecting that to come in the same. They're expecting a slight uptick in the core CPI month over month. I actually disagree with that. I think it's going to come in at that 0.2%. The October and November holiday sales were not very good. So I don't see the consumer price index really rising from that. And knowing how we've been seeing the PMI dropping, um, that should go somewhat hand in hand. Not always, but they should be close together. Um, Kind of same thing with the non-core CPI. They're expecting it to come in at 3.1% compared to the 3%. Again, I'm really expecting this to come in at 2.9% to 3%. I really don't believe we will see the higher data. I could be wrong about that though, but we will see. Um, just a lot of the previous data sets we've been getting have been showing cooling. We did have a core retail sales that was a little high for October, so if there's anything that's really going to push that number up, it'll be the retail sales, but we've been seeing the labor market really struggling. We've been seeing wages going down. Um, it really should translate to a lower CPI overall. Now, the initial and continuing jobless claims, we should very likely see both of those increase. Now, the forecast is expecting, um, you know, slightly lower results than last week. Last week we had the 236,000 initial jobless claims. But they are expecting the continuing jobless claims to basically revert back to where they were prior. If you remember, we talked about how last week there was that kind of weird reading where the continuing jobless claims lost 120,000 continuing, unemployment insurance claims. So we don't know if that's people falling off the claims themselves or if those were new jobs, but it doesn't suggest those were, people that got new jobs because we've been seeing, again, the hourly wages going down, employment cost index going down. And once the employment cost index goes down with the hourly wages, that's really showing that no one's, picking up new hires. No one's really stimulating the labor force at all. There's really nobody finding work right now. Um, so yeah, Then we also have the Philly Fed employment rate. Not really too interested in that. But all this data comes out 8:30 in the morning. It will be very important. But really what I'm looking forward to for Thursday, which isn't going to be showing on this screen, is the Bank of Japan rate decision. Now, it is scheduled for between 9:45 p.m. to 11 p.m. Uh, Eastern Standard Time. Usually the rate decision comes out at 10 p.m. So that's kind of what I'm looking for when the Bank of Japan rate decision comes out. So um, we did see that the Bank of Japan had a very, very strong treasury bond sale, and that's exactly what they're wanting to see for them to increase the rates. Uh, so yeah, I do believe that we will see the 25 basis point rate hike, and we know that Governor Ueda has been talking about, wanting to see continuation of the increased rate hikes. So if we see, um, the Japanese JGBs continuing to increase in yield, then the BOJ will continue to increase their rates. And as long as they do that, and as long as the sales on the JGBs are good, then that will help the carry trade. Um, if the sales on those JGBs start falling off at any time, then the carry trade really starts to get exposed. Now, the real question is if the carry trade is really going to unwind over this 25 basis point rate hike. Personally, I do think we will see some unwinding just due to all of the selling throughout the market. We've been seeing Bitcoin liquidating for months now. We've been seeing a lot of different markets really reacting in ways that's telling us that we should anticipate some sort of very volatile event to occur. So that's the data. Now, something I do want to cover is a few data sets I've been looking at that really kind of sums up if a major recession is coming. All right, and I'll go over what's going on in this chart. We have the effective federal funds rate, which in this chart is showing at 3.88%. It's currently at 3.64%, so it's even lower than what it's actually showing in this chart. So that's this red line right here. This blue line right here is the 10-year treasury minus the 2-year treasury spread. So this is telling you the level between the 10-year treasury and the 2-year treasury. And I'll explain why that's important in a moment. And finally, this is the unemployment rate. So obviously just the current unemployment rate. This is going to show at 4.4% in this graph, but currently it is at 4.6%. I believe they don't have that updated for this chart. Yeah, so it's showing previously August of the 4.3% in August, not the current 4.6%. So this is actually a lot higher than what it's showing, and the federal funds rate is a little bit lower than what it's showing. So, with that said, going over kind of what's going on in this picture, I want you to forget about the federal funds rate for a second and go over the 10-year minus the 2-year and the unemployment rate. And these like to travel very, very close together. So when we see the spread between the 10-year minus the 2-year start to increase with the unemployment rate increasing, which we are currently seeing both of those trending upward, generally that leads into a recession. Um, each time we've seen that occur, both of those are curving upward, curving upward, curving upward, leads into a recession, leads into recession, leads into recession. Okay, very likely we're going to get a revision where we're already kind of in a recession due to how bad this data is right here. Now, let's put that in conjunction with what's going on with the federal funds rate. So, as you can see, the federal funds rate has this area where when they do the hike process, they find the really effective rate where they can stay neutral, and then they start dropping it from there. They find the effective rate where they can hike it until it's neutral, and then they drop it once the cracks start forming. Rinse and repeat. They hike it upward, cracks start forming, and pull down. Even though this was COVID, all these data sets are still working all perfectly together. And again, we are already out of that cycle. Um, we saw the rate hikes, we saw the neutral, and now we're pulling downward. When you see the federal funds rate starting to pull downward, when these other two data sets are pulling upward, that leads into generally a recession. Um, so very likely we're already in a recession, seeing how the unemployment rate is a lot higher than what it's showing right here, and the federal funds rate is lower than what it's showing right here, and the 10-year minus the 2-year is showing correctly, but it is at 0.67. Generally that's a pretty high level, but it's not exactly the highest level. But it's always starting to rise as we're starting to enter into a recession. And the reason for that is because the low end of the yields drop off very drastically. And that's what causes this to pull upward. Because I like to discuss, the zero interest policy, or zero interest rate policy uh, times, which is called ZIRP. Um, Generally, when you enter into ZIRP, not all the rates go to 0%. It's generally the short terms are moving to that 0% range, and you're seeing the federal funds rate moving to that 0% range, and that's so that they can manage their debt and everything, clear the debt cycle like they generally try to do. And from that, um, generally the long end likes to keep roughly a 2.5 to 3% ish yield between the 10-year and the 30-year. So we still have some work to do on the 10-year, the 30-year, and the 20-year, Um, yeah, I just thought this was an interesting data set that some of you would like. Now, it doesn't exactly tell the full story. It's not showing the quarter over quarter GDP. And again, we've discussed that how prior for a recession, you'd want to see two of those data sets showing a negative. Now, the Treasury has changed that to be three. Um, Last quarter over quarter GDP would have been the third negative in a row, uh, if the imports were not skewed in that or in that data set. And the reason why the imports were heavily skewed was because we had President Trump's tariffs. The tariffs really paused importations and everything, which really drastically manipulated the GDP, and it showed a very large increase when it wasn't an increase. It was just the imports were very skewed. So, very likely we will see some sort of revision. That's why I'm saying I'm already expecting us to kind of sort of be in a recession already. I just think that we haven't gotten the data sets to really fully convince people yet that the upside inflation risks aren't there. Um, but one thing I also want to show with this chart is what's a trend that occurs very, very often. When you leave this rate cycle or this rate hike cycle, you enter into a ZIRP cycle. And even though we're not in a ZIRP cycle in the 2002 to 2004 range, that is pulling the rates very low. Okay. pulling back up, entering into a neutral, and then entering into an extremely long ZERP cycle. Rates pull back up again, pull back down, right back to ZERP. Um, Again, see the rates pull back up, and very likely they will pull back down into a ZERP stance, or potentially a stance where we see right here where they are elevated, pull back down. Not entirely ZERP, but very close. Um, with us having the prior 2018 to essentially mid 2019, the rate hikes, I do believe that kind of mimics this range where we had that first cycle, small recession pull down, second cycle, large recession pull down. So, first cycle, small recession pull down, second cycle, large recession. Expectation is to pull down. So, that's just some more data sets, and I figured you would all enjoy that. So, let's go into the technical analysis. If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime. And getting into the SPY technical analysis, as always, let's go ahead and turn on our moving averages and Bollinger Bands, and let's go over it. So we discussed in yesterday's video how there was an extremely large potential of us pulling upward, having that 5 mod test, and from that 5 mod test either starting to head back up to the upper Bollinger if we had good news, or starting to break down towards the 20 mod. Um, Obviously, we had the breakdown from the 20 mod, and just to show on the hourly, here's really where that 5 mod test was rejected. We saw the rejection from the lower bounds of the 5 mod, pulls straight into the 20 mod itself. From there, we saw the test all the way to the lower bounds of the 20 mod, and from that range, we broke down all the way below the 50 mod. Now, currently, the price is at 672.61, but the market closed at 671.40. So my expectation for the 5 mod actually pulls it all the way under the 20 mod as of tomorrow. That means that by all technicals, we have crossed off 2 of the short-term bear indicators that are, major trend shifts for me. And that is the 5 mod crossing under the 10 mod and the 5 mod crossing under the 20 mod. Now, what we're looking from here is for the 5 mod to cross under the 50 mod and for the 10 mod to start crossing under the 20 mod. That will take a couple days. The 5 mod will do a lot of the work in a shorter time frame, so very likely over the next 2 days, if we see continued selling, we can see the 5 mod pulling down almost towards this lower Bollinger range. Potentially if we see the price action of the SPY actually starting to pull down to that range, so say we close this inverse cup to the 650, then the 5 mod would be pulling underneath the 50 mod very, very quickly. It'd probably take a whole 1 to 2 sessions. The 10 mod is going to take probably about another week to really start pulling underneath the 20 mod. But if we continue to see selling, if we see this cup close to the downside at that 650 range, then not only is our short-term moving average of the 5 mod going to be underneath the 20 mod and the 50 mod, but we will have the 10 mod underneath the 20 mod and the 50 mod, and we will have the 20 mod underneath the 50 mod as well. And that's something we've been kind of talking about for a while, how this prior move, we did not get the 20 mod pulling underneath the 50 mod, which is generally something we see happen, within the standard trading of SPY, is that even during the rallies, you will generally see major support tests of seeing the moving averages pull underneath the 50-day moving average. We haven't seen that since, obviously April, and that's kind of a big deal, because that's not normal, which means that potentially we could be brewing into a pretty large sell-off here. Now, with that said, I'm going to turn off the moving averages for a moment. Sorry if I sound out of breath. I'm super, super tired. Um, I'm going to delete this for the bullish structure, delete that for the bearish structure, and for now we're going to delete the bounce, because now we're back in the consolidation channel. Now, we do have to hold below this 7, or not 7, excuse me, this 676.21 range for that upper consolidation channel. And that range is really important because, again, if we hold um, below this level, if we break below this major buying channel level, then this is heavily suggesting that the price action is going to be trading from the top of this consolidation channel all the way to the bottom. And looking at with the lower Bollinger, the lower Bollinger is not at that bottom level exactly, but as the price starts pulling towards that level, the lower Bollinger will curve downward, kind of like how you saw here. You see how the lower Bollinger is really hugging this bottom range. Um, that's a very, very strong consolidation channel bottom. The Bollinger pulls down to that bottom, bounces up to the upside a little bit, and now we're back down, having the slight bounce upward. As we start pushing down, that will pull up towards us a little bit, but it will pull back down as we start pushing towards the lower Bollinger, and towards that lower consolidation channel. Now, the main thing that we have to be careful of here is that we're still within this buying channel. As long as we're within this buying channel, the chance for a bounce above the consolidation channel all the way to the upper Bollinger is extremely large. And the reason for that is because that would be rejecting the bearish downside. That would turn this into a cup and a handle at that point. We would then fill the handle range, build a small handle from that, and then the upside is open again. Um, we have rejected the upside in the current cycle, but that doesn't mean that throughout the next 2 days, with all the massive data sets we're having, we can't see buying back up to the upside. With the 5 mile just now crossing the 10 mile, and I believe tomorrow we will see the 5 mile crossing the 20 mile, and that means that within 1 to 2 trading sessions, if we see a lot of buying, the 5 mile would pull right up above the 10 mile and the 20 mile, and we'd be bullish again. So even though it looks very bearish, even though we're starting to really break some of these, longer term moving averages, we still need to be very careful as long as we're still above this major buying channel. Now, again, I do think the news from the Bank of Japan, I do think the CPI and the PCE data will hold the SPY price downward. And to just kind of show why I believe in that even further, is that Bitcoin has been very, very strongly selling off. And not only has it been selling off, is that this bullish structure that we've been looking for has not been completing. Actually, we've been seeing further downside, which really solidifies that very, very likely we are going to see this extremely large inverse head and shoulders, or not head and shoulders, but inverse cup and handle to the downside, which that downside is all the way to the 74.4 thousand. Again, I've been talking about that level for quite a while. If we get to that level, I can't give financial advice, but sell everything, buy Bitcoin, um, because it's going to be a great year. But other than that, we're still seeing strong selling within Bitcoin. We're still seeing the dollar not fully pulling upward, and we talked about how previously we were seeing a lot of potentially bullish structure to the upside. Um, Again, I just kind of want to highlight this is that this is still a very bullish cup and handle setup on the dollar. Um, Potentially with the Japan, yen carry trade going south, this could pull back up very, very quickly. And if we see the dollar pulling back upward again, it will continue pushing Bitcoin down further. Um, Now, on the flip side, once people start really unwinding the trade, we will see the dollar pulling downward. Um, but that can also pull downward with Bitcoin. So even though I generally say to watch the dollar very, very closely, when it comes to Bitcoin, don't be misled thinking that you see some massive pull down in the dollar that all of a sudden um, it's a safe time to buy Bitcoin. We want to see some major indicators uh, aside from that are suggesting upside throughout tech, throughout multiple different markets. We want to see that upside start being taken before we even really attempt to buy this dip in this range. Um, Now, again, if the news is good, we can see Bitcoin pull up, you know, complete this bullish structure, work on completing a cup to the upside, and again, we'd be at the bottom of that major consolidation channel, and that would also be an extremely strong range to buy because I would suggest that we'd be going all the way back up to the all-time highs. But in the current process or in the current cycle, I'm extremely, extremely hesitant because that 74.4 thousand looks like it's going to get pushed. Um, I'd be very, very, very surprised to see that not occur. We have the VVIX starting to pull back upward. Again, once that is above 98, that tells you that there is selling occurring within the equities. So be cautious of that. Now, very quickly over TLT, and this does kind of tie into what we were seeing within that chart with the federal funds rate and everything. But with that chart on TLT, or with the federal funds rate and everything, that supports seeing buying for TLT quite heavily. And what we're wanting to see at this point is we're wanting to see the the shorter term yields starting to pull downward very drastically. And this is kind of the last phase of that bull steepening process is that the short term yields, we're now expecting these to pretty much just drop at any time. Any major data set can really just drop these at this point. That's the first major step. Is these long term or these short term yields are very very likely going to drop very drastically. Once that happens, it will probably be about 2 weeks, maybe less, maybe more, and then we will start seeing the long term yields following that. And that's the standard SERP process, where you see let's kind of just put these together. You see the long term or you see the short term yields really stop or really just drop drastically. And then you will see the long term yields drop after that. COVID doesn't really show a good example, but my chart is not working right now. Can't really show the 2008. I'll have to show in a Fred chart tomorrow. Um, but with this trend and everything in the 10-year, the 30-year, everything is still showing a downward trend. Even the stickiness in the 30-year right now, this is still a very strong downtrend with a selling channel right there. And we have a selling channel that is holding up right in here. I can't draw on this chart because Webull hasn't made it so you can draw on the yield charts yet, but there's just a lot of things that are telling us that we will be seeing buying for TLT. We have our moving averages and the Bollingers all suggesting that now that we've tested the 20 MA, or excuse me, the 5 MA, we had our lower Bollinger move. We're seeing bullish structure from that lower Bollinger move at the bottom of that major buying channel. We've now tested the 5 MA, and seeing buying from here heavily suggests that we'll see the 20 MA retested. From that retest of the 20 MA, we would see buying back up to the 90, and then from that buying up to the 90, that would complete a cup, small handle from that range, and then it's back up to the 92. So um, we are seeing the ADL starting to pull up as well on TLT. Sorry, I'm just getting extremely exhausted. Probably going to end the video here. There's a lot of data over the next 2 days, so we will have a lot to talk about in tomorrow's video. So I'll probably just save the rest of what I want to talk about for that. With that said, be very cautious with your trades tomorrow. Um, but thank you for watching. Thank you for, liking my videos and subscribing. Finally hit 1,000 subscribers. I heavily appreciate it. Thank you all so much. Um, Other than that, I hope you all have a great day and I will talk to you all in tomorrow's video. Take care, everybody.